America's biggest retailer just printed its worst domestic quarter in 6 years. Comparable sales up 2.6%, the slowest in more than 6 years. The market took about 9% off the company in a single day. But that same morning, in the same deck, the company printed something else. Take health and wellness out of that number, and the comp was 3.4%. It put that figure on a slide it had already titled, in its own words, "After Maximum Fair Price Regulation." Nobody carried the slide. A number this famous shouldn't be this easy to misread. Every headline that day said the American shopper was finally cracking. The company's own decomposition said something narrower and stranger. So which one's true? And what exactly did that number measure? You already know this number, even if you've never looked one up. Comparable sales, same-store sales. It's the figure every retailer is graded on, and the one every business report leads with. It's meant to answer something simple. Are the stores a company already had doing better than last year? For 4 straight quarters before this one, the answer was a comfortable yes. 4.6, 4.5, 4.6, 4.1. That's a company doing fine while everyone else argued about whether the consumer was. Then 2.6. The read was immediate and near unanimous. If the store 280 million people a week walk into is decelerating, the shopper must be pulling back. That story isn't stupid. It's the obvious reading. The market acted on it, and the guidance for the next quarter didn't argue. Walmart guided adjusted earnings to between 62 and 64 cents. The street wanted 68. But open the presentation the company furnished that same morning, and the number decomposes into something the demand story can't hold. Start with the split, because Walmart gives it to you directly. Nothing here has to be inferred. That 2.6% breaks into 2 parts. Transactions, meaning how many times somebody came in and bought something. And average ticket, meaning how much they spent when they did. Transactions were up 1.5%. Ticket was up 1.1. Sit with the order of those. Trips are the bigger half. More people came, more often. The release says it in the company's own words that the comp was, quote, led by growth in transactions. That isn't what a retreating shopper looks like, and it's the inverse of last year, when the same class of comp was carried by ticket rather than trips. The mix flipped, while the headline fell. So if it wasn't the trips, the next suspect is price. Except the price data says nothing dramatic happened there either. Like-for-like inflation across the business ran 1.4%. In grocery, 1.3%. More trips, mild inflation, a falling comp. Those 3 don't sit together, which means something inside the number is subtracting, and it isn't the shopper. It's the pharmacy counter. And what happens there is the thing this whole film is about. Here's the setup. A drugstore counter is one of the oldest traffic tools in retail. Cheap prescriptions pull somebody into the building every month, reliably, whether or not they needed anything else. Then they buy something else. That's the moat, not the drugs. The trip the drugs guarantee. Now watch what the company disclosed about that counter this year. Script counts, meaning prescriptions actually filled, grew mid-single digits. The units went up. And the dollars in that category went down. Walmart discloses roughly 900 basis points of negative impact in health and wellness. From deflation, it attributes to maximum fair price, implemented January 1st. Look at those 2 arrows, opposite directions, same shelf, same quarter. That's the whole mechanism, and it's on page 13 of a slide deck. Because here's what a comparable sales number actually is. It counts dollars. It has never counted units. It can't tell the difference between a customer who stopped coming and a price somebody else lowered. So who lowered it? This part's worth being exact about because it's the part most likely to get mangled. In 2022, Congress created a program inside Medicare that lets the government negotiate prices directly on a small number of very expensive drugs. The prices it produces have a name written into the law itself. The statute calls them maximum fair prices. That matters more than it sounds. When Walmart's slide says maximum fair price regulation, that isn't a company inventing a soft phrase for its own bad quarter. It's Congress's own term. The prices took effect on the 1st of January this year, on 10 drugs covered under Medicare Part D. That's the regulator's description, not the company's. Now be careful with the next step, because the honest version and the tempting version are different things. The regulator never mentions Walmart. What the regulator establishes is that the rule exists, when it started, and what it covers. Walmart is the one attributing the drag. And the drag it attributes is roughly 125 basis points of its comparable sales, from pharmacy deflation and brand to generic transfers related to that regulation. 125 basis points is 1.25%, on a comp that printed 2.6, which raises the obvious question. What's that worth in money? Walmart never says. It gives you the rate and stops there. So we can convert it carefully, and I want to show the working rather than hand you a number. The segment's sales in the year-ago quarter were about $121 billion. That figure is filed, not estimated. Apply the disclosed rate to it, and you get roughly $1.5 billion. A band, though, not a point. Walmart published 2 different rates for this effect in 2 different documents. On the lower one, you get roughly $1 billion. On the higher one, roughly 1 6/10. So call it between $1 and $1.6 billion, and understand it's our arithmetic on the company's disclosed rate, not a figure the company published. Those 2 documents deserve a beat of their own. The press release says 80 basis points of health and wellness headwind. The presentation says about 125. Both are Walmart's. Both are correct. They measure different things, which means the size of this effect depends on which Walmart document you opened. Most people opened neither, and that's the actual finding here. It isn't that a company hid something. Walmart published the rebuttal to its own worst headline in 6 years. The same morning, the same deck. On a slide it had titled, "After the Cause." Comparable sales, excluding health and wellness, 3.4%, printed directly under the heading, naming the regulation. The market moved about 9% the other way. And underneath it sits the thing almost nobody knows about, the most quoted number in retail. A comparable sales figure counts dollars and can't see units. Walmart's pharmacy shelf sold more prescriptions and comped less because a federal cap set the price. Read that again. The metric an entire industry is graded on recorded a policy that made your medicine cheaper, as though it were a shopper who stopped showing up. Now the part that cuts against me, and I want to be precise, because getting it wrong would make this film exactly the thing it's criticizing. Take health and wellness out entirely, and the comp is 3.4%. That's still below the 4.6, 4.5, 4.6, and 4.1 Walmart printed in the 4 quarters before it. The pharmacy line is the largest single cause we can identify. It isn't the only one, and this film is not going to tell you the consumer is fine. There's a forward-looking one too. Walmart's own guide for the next quarter came in under what the street wanted, 62 to 64 cents against 68. A one-time regulatory line item doesn't explain a forward guide. And one more limit, on the units point. Walmart disclosed trips, and it disclosed script counts. It didn't disclose a total unit count. Trips rose and scripts rose. We're not going to claim more than the company measured, so if the scoreboard number got cut by a price cap, where did the quarter's actual profit come from? Not from the shelf. Walmart's gross profit rate in the US reached 29.4%, up 158 basis points. In the same quarter, its comp broke. Those two numbers point opposite ways, and the company names the driver itself. Improved business mix, it says, primarily from growth of digital advertising. So look at what's actually growing. Advertising in the US up 38%. Walmart Connect, its ad platform, up 43%. Marketplace sales, where third-party sellers pay for access to Walmart's traffic, up 52%. Membership fee revenue globally, up 17%. Against segment sales of 3.5%. Every one of those is money paid by somebody other than the shopper at the register. Suppliers buying placement, sellers buying access, members paying a fee before anything is sold. And none of it is what a comparable sales number measures. That's the quiet part of this quarter. The scoreboard and the engine have started to come apart, and only one of them is what the market grades. Compare it to the one competitor built the other way round. In its own most recent quarter, Costco collected about $1.4 billion in membership fees against roughly $2.8 billion of operating income. By our arithmetic, that's around half. A fee collected before anything is sold sits outside the reach of any merchandise price rule. A comp built on a regulated shelf doesn't. Same retail economics, two very different exposures to a law neither company wrote. Now the last piece. It's the one that got reported backwards. The quarter was widely described as a profit beat with a soft outlook. Operating income did rise sharply, up 28.8% from about $7.3 billion to about $9.4. But go down 2 lines on the same statement. Net income attributable to Walmart fell 9.4%, and earnings per share on a reported basis fell too, from 88 cents to 80. The operating line rose. The bottom line didn't. And that operating line, the company tells you in its own release, includes the impact of tariff refunds received. Setting that aside, it says, underlying growth was at the top end of guidance. It also says the outlook reflects prioritizing the remaining refunds into price investments. And the finance chief, in the filed release, asks investors to consider this quarter and the next one together to assess the underlying growth of the business. That's not evasion. Read it plainly. That's a company volunteering, before anyone asked, that the good half of its quarter doesn't repeat. Raise the year. Guide the quarter down. That's the shape of a one-time benefit landing now and being spent later. So, the ledger of this quarter reconciles in an unusual direction. The party that gained is the person whose maintenance prescription got cheaper on the 1st of January, and who has no idea that saving is the single largest identified line in America's biggest retailer's worst quarter in 6 years. The party that lost, about 9% in a day, is Walmart's own shareholders, on a misreading of a decomposition sitting in the same document. The number wasn't wrong, the reading was, and the correction was sitting on page 14 of a public file the entire time. I'll put the uncomfortable half of this to you. Walmart published the counterfactual and the market priced the headline anyway. Does that make the reporting the failure? Or is a number this crude simply not fit to be the thing an entire industry gets graded on? There's a second story underneath this one. The advertising and marketplace money, now carrying Walmart's margin, is a different company hiding inside the old one. And comparable sales can't see that either. That one's on screen now.